You must have read numerous books on investing written in recent years. Nothing, however, compares to the influential books from which great investors today learned. Welcome back to our channel. In today's video, we're going to talk about one of the most influential books on investing ever written, The Intelligent Investor by Benjamin Graham. Published in 1949, it has established itself as a timeless work in the field of finance. Benjamin Graham, the father of value investing, was a well-known value investor, educator, financial securities researcher, and Warren Buffett's mentor. In this book, he teaches the readers what it means to be a high-value investor and the proper method of investing that has shown to be successful over the course of several decades. This book is a must-read for anyone interested in investing, especially those who want to learn and make wise investment decisions. Want to learn more about this book? We will discuss the essential ideas and takeaways from The Intelligent Investor, so sit back, relax, and let's get started. First off, what is value investing? Benjamin Graham's The Intelligent Investor is built around the concept of value investing. These powerful words involve buying stocks that are trading below their intrinsic value, which is determined through a careful analysis of the company's financial statements, management, competitive landscape, and other factors. The idea is that over time, the market will recognize the true value of the company and the stock price will rise accordingly, resulting in a profit for the investor. Graham argues that this approach is more reliable than trying to predict the future performance of a company, which can be impossible and subject to many external factors. By focusing on the intrinsic value of a company, the investor can make more informed and rational investment decisions. However, Graham emphasizes that value investing requires a significant amount of research and analysis, and it is not a quick or easy way to make money. He encourages investors to do their own research and analysis, rather than relying on tips from others or following the crowd. Another key aspect of value investing is diversification. Graham recommends investing in a diversified portfolio of stocks, rather than putting all your eggs in one basket. This helps to minimize risk and protect against the volatility of individual stocks or sectors. Overall, value investing is a long-term approach that requires patience, discipline, and a commitment to doing your own research and analysis. But for those who are willing to put in the effort, it can be a highly effective way to build wealth over time. Moving forward, let's talk about the difference between investing and speculating. This is another focal point that was discussed in the book. Graham believes that investing is a long-term activity that involves studying a company's fundamentals and purchasing its shares at a reasonable price based on its intrinsic value. Speculating, on the other hand, is a short-term activity that involves purchasing and selling stocks in response to market trends or rumors. Aside from that idea, Graham also asserts that speculating is risky and frequently leads to poor investing decisions. He believes that focusing on value investing, which involves carefully studying a company's financial statements and management before making any investment decisions, is the greatest method to achieve long-term success. Graham also emphasizes the value of patience and discipline in investing. He recommends investors to avoid trading in and out of the market based on short-term swings and instead focus on the long-term fundamentals of the firms in which they invest. Part 3. The Margin of Safety. The concept is a crucial part of Graham's philosophy of value investing. Graham defines the margin of safety as the difference between the current market price of a stock and its intrinsic value. In other words, it's a discount at which an investor can buy a stock relative to what the stock is truly worth based on careful analysis of its financials and other factors. The larger the margin of safety, the greater the potential for profit and the lower the risk of loss. By focusing on stocks with a large margin of safety, investors can reduce their exposure to unforeseen risks and market volatility. The margin of safety provides a cushion against unexpected events and helps to ensure that the investor is buying a stock at a price that is significantly below its true value. Graham notes, however, that calculating the intrinsic value of a stock is not an exact science, and it requires careful analysis and research. Rather than trying to squeeze out every last bit of potential profit, he recommends investors to err on the side of caution and only buys in equities with a significant margin of safety. The margin of safety is a fundamental principle in value investing, and it serves as a safeguard against the risks and uncertainties of the stock market. By focusing on stocks with a large margin of safety, investors can Mr. Market at behavioral finance. Have you heard of Mr. Market? This section is one of the most important parts of the book, which explains the concept of Mr. Market. Graham uses the metaphor of Mr. Market to illustrate the concept of market fluctuations and emotions that drive them. In Graham's view, Mr. Market is like a business partner who offers to buy or sell stocks every day at a different price, depending on his mood. Some days he may be euphoric and willing to pay top dollar for a stock, while others he may be depressed and willing to sell it for a fraction of its value. Graham emphasizes that investors should not rely on Mr. Market's offers to make investment decisions. Instead, they should focus on the underlying fundamentals of a company, such as its earnings, assets, and growth potential. Investors should only buy a stock if it is trading at a significant discount to its intrinsic value, regardless of Mr. Market's mood swings. The field of behavioral finance also plays a significant role in this section of the book. Graham acknowledges that emotions and biases can influence investment decisions and cause investors to make irrational choices. He discusses several common behavioral biases, such as overconfidence, herd mentality, and loss aversion, and offers strategies for overcoming them. We can learn from this section the importance of separating emotions from investment decisions and focusing on the underlying fundamentals of a company. By treating Mr. Market's offers with skepticism and taking a rational, long-term approach to investing, investors can avoid the pitfalls of emotional decision-making and increase their chances of success in the stock market. Investing in bonds. Graham explains that this is a way to balance the risk and return of a portfolio. He argues that bonds are generally less volatile than stocks and provide a steady stream of income in the form of interest payments. Graham suggests that investors should allocate between 25 to 75% of their portfolio to bonds, depending on their risk tolerance and investment goals. However, Graham also notes that not all bonds are created equal, and investors need to be diligent in analyzing the creditworthiness of bond issuers, with a rating of A or higher from a reputable credit rating agency. He also advises against investing in junk bonds, which are bonds with a low credit rating and a higher risk of default. Graham also emphasizes the importance of diversification when investing in bonds. Investors should avoid putting all their eggs in one basket and instead invest in a range of bonds from different issuers and industries. By diversifying their bond portfolio, investors can reduce their overall risk and ensure a steady stream of income from a range of sources. The defensive investor versus the enterprising investor. Graham also tackled in his book these two types of investors. Graham thinks that a defensive investor should create a portfolio of high-quality equities and bonds that generate dividends. The defensive investor should also try to keep fees and costs to a minimum by investing in low-cost index funds or exchange-traded funds or ETFs. The enterprising investor should be willing to spend more time examining individual stocks and should have a high tolerance for risk. Additionally, the enterprising investor should have a higher risk tolerance. Graham suggests that entrepreneurial investors should make it their mission to purchase undervalued equities that come with a margin of safety and then sell such stocks once they achieve their true value. In addition, he recommends that the investor thinks about alternative investments such as real estate or private equity, in addition to traditional assets such as stocks and bonds. Here are 4 rules of investing we can learn from Benjamin Graham's book. First, diversify your stock and bond portfolio. Spreading out your stock and bond portfolio reduces risk and portfolio impact. Graham advises a stock-bond mix based on risk tolerance and investment goals. The second rule is to analyze the fundamentals of companies before investing. Before investing, study a company's financial statements, management team, competitive environment, and other essential variables. Graham advises investing based on research rather than rumors or market trends. Third rule, acquire inexpensive stocks and sell overvalued ones. Value investing seeks undervalued stocks. Graham recommends investors to wait for bargains on good companies. He advises against market timing, which is dangerous and tricky. Finally, be patient and consistent with your investment strategy. Graham concludes by emphasizing long-term thinking and investment strategies. Emotional investing can lead to impulsive and unreasonable action, he says. Long-term investors can succeed with patience and discipline. And there you have it, the most important points from The Intelligent Investor by Benjamin Graham. This book has had a profound impact on the world of finance and investing, and its principles have stood the test of time. Whether you're a beginner or seasoned investor, there is something to learn from this book. By focusing on value investing, analyzing the fundamentals of companies, and having patience and discipline, investors can increase their chances of success. As always, we encourage you to do your own research and consult with a financial advisor before making any investment decisions. Thank you for watching and happy investing!